What if I told you that the money in your wallet, the numbers in your bank account, are not what you think they are? That they are, in fact, a magician's trick and illusion of value, backed not by gold or silver, but by a promise that was designed to be broken? We're taught that money is a simple tool, a neutral medium of exchange. But that's the greatest cover story ever told. Truth is, the very nature of our money was engineered in secret by a small group of men to create the most powerful system of control the world has ever seen. This isn't a conspiracy theory about secret societies. It's a conspiracy of fact, hidden in plain sight within the mechanics of central banking. Today, we uncover the story of how central banks invented a new form of money, not for our benefit, but to control economies, governments, and ultimately, every single one of us. To understand the trick, we must go back to its origin. The year is 1910. The location: a secret private railroad car on a secluded island off the coast of Georgia, USA. No press, no public records. The attendees: a handful of America's most powerful bankers and a sympathetic US senator. This was the Jekyll Island meeting. Their mission: to design a central banking system for the United States in response to a series of bank panics. But their true goal was far more ambitious: to create a permanent, centralized mechanism to control the nation's money supply. The problem they faced was a simple, physical limitation. Under the gold standard, the amount of money in circulation was tied to a tangible asset. Couldn't just create more gold. This limited the power of banks and governments. It was a cage. Their solution was nothing short of financial alchemy. They devised a plan for a new entity, the Federal Reserve, that would not replace the gold standard immediately, but would create a parallel system of money on top of it. A system of credit. This is the first twist. The Federal Reserve, created by the 1913 Federal Reserve Act, was sold to the public as a way to stabilize the economy and prevent bank runs. In reality, it was designed to institutionalize and centralize the power to create money. It wasn't about ending the gold standard. It was about building the escape hatch from it. Now, to understand their invention, you must first understand the original trick: fractional reserve banking. For centuries, banks realized that not everyone would demand their gold at once, so they could lend out more paper receipts than they had gold in their vaults. This is fractional reserve banking, creating money from debt. But it was still constrained. If too many people demanded gold, the whole house of cards would collapse. The central bank supercharged this. It became the banker's bank. Its role was to ensure that if one bank faced a run, it could provide the cash, the liquidity, to stop the contagion. But how would it provide this cash? By inventing it? The central bank's key invention was the central bank balance sheet. When it lends money to commercial banks, it doesn't hand them stacks of cash from a vault. It creates a digital entry, a credit to the bank's reserve account. This money did not exist seconds before. It was created from nothing, backed by the bank's promise to repay, often with government bonds as collateral. This was the paradigm shift. Money was no longer a thing you could hold. It was a liability of the central bank, an IOU. The entire global economy began to run on this system of IOUs. The cage of the gold standard was being picked, lock by lock. For decades, this new system coexisted with the ghost of the gold standard. The US dollar was still convertible to gold for foreign governments. This acted as a check, a discipline on the Fed's money printing. If America printed too many dollars, other countries could redeem them for gold, draining Fort Knox. But discipline is the enemy of control. The breaking point came in 1971. President Richard Nixon, facing massive spending on the Vietnam War and the Great Society programs, was watching US gold reserves dwindle. France and other nations were rightly suspicious of the ever-growing pile of US dollars and were demanding gold in return. So on August 15th, Nixon made the most significant financial decision of the 20th century. He temporarily suspended the convertibility of the US dollar into gold. It was the financial equivalent of cutting the anchor line. The US dollar, and by extension the global monetary system, was now completely untethered. It was a system of pure fiat money that has value only because the government says it does. This was the moment the invention was complete. The central banker's dream was realized. There was no external constraint left. The money supply could be expanded, literally, at will. The immediate effect was a party. The gold anchor gone, credit exploded, the economy boomed. But every action has an equal and opposite reaction. The reaction was runaway inflation in the 1970s. The value of the dollar, now backed by nothing but trust, began to evaporate. The Fed had the power to create money, but it quickly discovered it had no precise power to control its value. They had unleashed a beast. The fix came in the early 1980s under Fed Chair Paul Volcker. He slammed the brakes by raising interest rates to unprecedented, punishing levels, over 20%. This stopped the inflation, but it caused a brutal recession. It was a blunt instrument. This is the central paradox of their control. Their primary tools, interest rates and money creation, are like trying to perform brain surgery with a sledgehammer. They can crush activity or stimulate it, but they cannot create sustainable, healthy growth. They can only create boom and bust cycles. Every subsequent crisis, the 2000 dot-com bubble, the 2008 financial crisis, the 2020 pandemic response, has been solved with the same tool, creating more of the magic money. In 2008, this process was given a new name, Quantitative Easing, QE. Instead of just creating money for banks to lend, the Fed started creating trillions of dollars to buy financial assets like government bonds and mortgages directly. The Fed's balance sheet exploded from under $1 trillion in 2007 to over $9 trillion today. They created more money in a few years than had existed in the entire history of the United States before that. This didn't fix the underlying debt problem, it simply inflated the everything bubble stocks, real estate, assets, making the rich vastly richer, and further divorcing the financial economy from the real one. So, what does this mean for you today? You are not just an observer of this story, you are a subject in its final global chapter. The system of control is now fully operational. Your wealth is being silently transferred. The inflation we see today isn't an accident. It's the direct, predictable result of creating trillions of new currency units. It is a hidden tax on your savings and your income. The business cycle is now a central bank cycle. Whether you get a mortgage, a car loan, or a business loan depends not on the free market, but on the whims of a few unelected officials in a marble building. There is no escape. When COVID-19 hit, the response was not to fundamentally restructure the economy. It was to create another $5 trillion out of thin air. This is the only tool left in the toolbox. The system cannot function without an ever-increasing dose of its own drug, debt. The control is so complete that we mistake it for nature. We think rising asset prices mean we're wealthy, not realizing our actual purchasing power is being eroded. We think central banks are saving the economy, not seeing that they are merely postponing a greater reckoning. So, as we reach the end of this story, here are the 3 undeniable truths you must remember. Money is not a thing, it's a relationship. It is a constantly fluctuating IOU in a game where the central bank is the ultimate scorekeeper, and they can change the rules and the score at will. The primary export of the modern economy is debt. The most profitable product is no longer a car or a smartphone. It's a bond, a mortgage, a credit card statement. The entire system is designed to run on perpetual debt creation. Central banks don't control the economy, they distort it. Their interventions create false signals, misallocate capital on a massive scale, and ensure that the rich, who own assets, benefit from the money printing, while the poor and middle class who rely on wages are left behind. The warning is this: every fiat currency system in history has eventually failed. Every single one. The Roman denarius, the Continental, the German Papiermark, the Zimbabwean dollar. They all return to their intrinsic value, 0. Our system is not an exception to this rule. It is merely the latest and largest iteration of the experiment. The open-ended question for you is, what happens when the confidence in the magician's trick finally evaporates?